I believe we are at an inflection point in the market, and that is why I'm calling this presentation Crossroads, because we have multiple questions that we need to find answers for. And which one is it going to be? Are we going to focus on the virus and extend the shutdown, or are we going to focus on the economy and open up the businesses quicker? And this balance here is very fragile, and it depends how quickly we are going to do this, how the outcome is going to be. So there's a lot of uncertainty in this relationship. Also, I hear a lot of people complaining about the move to the left that we are seeing with the money printing by the Fed, with the stimulus packages from Congress. And I wouldn't even call them stimulus. They are simply trying to keep the lights on because they do not have a choice. So I believe that socialism is the wrong word, because if we were just to do everything the way we used to, and we would just let these businesses fail, then also capitalism would fail, because we would have so many bankruptcies, and it would be a domino effect, because we would then, on top of all the bankruptcies in the regular businesses, we would also get bank failures, and with bank failures, everything else collapses. So we do not really have a choice to not do anything about it. So I think we just have to accept it, that the government has to step in, because the alternative would be so much worse. Then another question that needs to be answered is this recovery, or the recession, or the depression, whatever we are going to have, is it going to be an inflationary one, or are we going to see deflation? And I believe that this will not be a deflationary depression, because deflation happens either when you get tremendous improvements in efficiency in the economy. So technology is deflationary. But deflation that is caused by innovation is good deflation. There is nothing wrong that prices for flat screen TVs are coming down, that prices for computers are coming down. This is not a bad thing. This is good deflation. The deflation that we must avoid is deflation when capital gets destroyed. And in the past, whenever we had an economic crisis and we let these businesses fail, when these businesses then default on that debt, that money disappears from the books, and with that, money gets destroyed. And when money gets destroyed, it becomes this contagious effect that somebody was banking on that money, and then they get in trouble, and then they default on the debt. Then somebody else who did business with them, they are defaulting on the debt. So it becomes a self-fulfilling prophecy, and then all of a sudden, so much capital gets destroyed that we end up in a depression. But what we are doing on the other side, that we are trying to keep all these businesses open, and that we are pumping so much money into the system, that we will see some sort of inflation. But it will not be hyperinflation that a lot of people are whining about. It is usually the same people who are calling this socialism. We will not see hyperinflation, because in order for us to get hyperinflation, we would also have to have the state failing. When we look into history and we look at all the examples of hyperinflation, they do not happen simply because the government is printing money. You need more than that. You need to have an alternative currency to go to, and you need to have the faith of the people to totally abandon governments. So you need to have a corrupt government, and you need to have an alternative currency. I don't believe we have either of the two, because which currency is better than the dollar? You want to go into the euros? You want to go and trade with yen, or you want to trade with the yuan or the renminbi in China? I mean, give me an alternative. We also cannot use Bitcoin, because Bitcoin, it sounds beautiful on paper, but in reality, it is not useful yet, because the technology has not kept up with its potential. So for now, there is no alternative. And that is why I believe we will see inflation. It will not be hyperinflation. But it is an important conversation to have. And then the other question is, how will the economy recover? Is it going to be a U shape that we are going to drag for a long time at the bottom until we recover, or is it going to be a V shape? And I talked about it previously. I believe it will be somewhat of a crooked V, that the right side of the V will simply not be as steep as the left side of the V. So we will recover sharply in Q3, but we will not reach the levels that we have seen previously, and it will take probably years until we get to a GDP that is similar to a pre-corona. But there is so much data that will come out until then that it is not really useful to have a long-term view, because it depends pretty much on this relationship here between the shutdown and the economy. Are we going to see a resurgence of the virus and so forth? Then the last question that I want to attack here is, what is volatility going to look like? Because we have seen the last 6 weeks or so huge volatility in the market after we have seen these long periods of low volatility. And I believe that the high volatility regime is probably coming to an end. And there is a reason why I believe that to be the case. So if we look at the potential catalysts ahead, what kind of news, what kind of bad news could possibly come out that would shock us at this point? I mean, we've had the worst possible news there is. The entire economy is shut. So how could earnings disappoint when the bar is this low and everybody knows that Q3 will be better than Q2? So the earnings that are coming out are pretty much irrelevant. We also know that there will the government and J. Powell, they will not allow major bankruptcies. So what possible bad news, what earnings could be bad that would, I mean, so bad that would actually shock the market right here? And I find it very, very difficult to come up with a scenario that would disappoint to the downside. The only thing that could disappoint is if we open up the economy too quickly and we see a resurgence of the virus. Yes, that would be bad news, but we are not there yet. So I believe that remains to be seen how that turns out. And what about the unemployment report? Could it possibly disappoint when the numbers come out in May? I believe these numbers are pretty much also irrelevant, because everybody knows this is temporary and they will be hired back. What we don't know is at what rate they will be hired back. We will not get that information until like June, July. So there is no reason trying to attack that problem. So within the next 4 weeks or so, I do not believe there is any possible bad news that could shock the market. And the only news that could surprise the market is potentially better. And that is if we were to find a treatment, or if we were to make major progress in finding a vaccine. The only thing where I believe we could disappoint short term is when I read the Mickey Mouse news on Thursday, when the market gapped up because there was some reporting that remdesivir, the drug that Gilead is working on, was very beneficial to patients who have been really, really sick with the coronavirus, that they recovered quickly. I've read this before. It is anecdotal evidence, but that is not the real problem that I have with it, because I do believe that remdesivir, the odds of it being helpful are very high, simply because of math. Because remdesivir has been proven to be effective against MERS and SARS in animal trials before, and because of conditional probability, the odds are pretty good that it will be effective as well against COVID-19, because these viruses are related. So because of conditional probability alone, the odds of this being effective for the coronavirus that we are currently dealing with are high. But what my problem is, that the market is maybe overestimating its impact, because there are severe side effects to this drug. And if a quarter of the patients suffer from something, and I do not really know what it means, but if they then suffer from multiple organ dysfunction syndrome, this does not sound like a minor headache. So if the side effects are worse than the symptoms of the regular patient, then remdesivir will only be used for really, really sick people. So it will not really solve the major problem. It will help us keeping the death rate low. That is very important. So it is great news that we have remdesivir and that it is most likely going to be helpful for those patients. But it is not telling us that we can open up the economy because everybody just pops a pill and then they are treated and they get well. Because remdesivir is also not a pill. It is an infusion. So I believe short term, the market has priced in too much optimism when it comes to a treatment. But that is simply in the very, very short term. Maybe the next week we are treading water or we are pulling back a little bit in the market. But a few weeks out, I believe the risk is to the upside and not to the downside. And on top of it, when we look at sentiment, people are having a very, very hard time understanding how is it possible that we could have had so much bad news the last 3-4 weeks while the market rallied some 30% off the lows on March 23rd. It is causing massive cognitive dissonance and frustration in the market, and they are screaming manipulation, and they are screaming it's socialism, and this is all going to end badly, and so forth. In a sense, that is true. The market is manipulated, but the market also and has always tried to inflict the most pain. So it will do what the majority of people the least expect. That was not a proper sentence, but you know what I'm trying to say is it will take the path that inflicts the most pain and confuses the most amount of investors. And that is exactly what has happened. We have priced in the worst case scenario on March 23rd, and now we have priced in a recovery in Q3. Short term, we will likely stall here, but the next big move, I believe, it is likely to be to the upside, and then we have to see what happens with real economic data. But this won't matter until like maybe end of May, beginning of June. Up until then, I think the risk is to the upside, and the risk is more that people who are buying puts and who are betting on a resurgence of volatility, that they will get screwed. Because what I'm hearing is there are still people who are expecting a retest. They are screaming from the rooftops that this 30% rally is a gift. It is this beautiful short opportunity. I believe that will turn out to be wrong, and the more likely scenario is something that looks similar to what we have seen in 2019, because when we got these the vicious sell-off in Q4 of 2018 and then the reversal on Christmas, people were saying the same thing because they totally missed the boat. They got too pessimistic. Then J. Powell did his flip-flop and the market took off and never looked back. I believe odds are we will see something similar. And on top of it, gamma positioning has been on the short side. So market makers have been short gamma since February 24th. On February 23rd, I made a video that I called Salami Crash Ahead, warning about the significance when gamma positioning goes from long gamma to short gamma, and that we could see a significant sell-off. We are now close for gamma positioning to go from short gamma back to long gamma. And this has a significant impact on the volatility in the market. And if you do not know how the relationship between gamma positioning and volatility, how that works, I've made a video about that too. I called that bipolar. I will post all the videos that I have recorded in the past in the description, so you can look up what gamma positioning does to the volatility in the market, because it is the most important factor when it comes to volatility. And I believe that if the S&P 500 goes north of 2,900 or so, that then volatility will get crushed. And I don't want to make this video longer than it has to be. So if you want to understand what this means, gamma positioning, again, please check out the videos in the description below. And so the most important thing, what are we going to do with all this information? And I believe there are two trades to be had here. And one is simply based on the response by governments and by central banks, because we have talked about that Congress and the Fed and the ECB and the Bank of Japan and the PBOC, all the central banks, they do not have a choice. They need to print money because the alternative would be so much worse. We would have riots on the street and capitalism would fail, and then the risk of hyperinflation would actually be higher than if we are printing money, because it would at least it would take off the risk of social unrest on in the streets. So this, yeah, anyway, I think a lot of people have it upside down when they argue about this, because I believe most of these pundits, they do not possess the ability to use common sense. They are living in their own bubble, and with that they have lost the ability to assess situations objectively. At least that is my point of view. So I believe there are two trades coming out of this where the risk reward, I believe, is excellent, and that is that we simply bet on the policy response, that the weakness in the economy that we will likely see going forward will be met with lots of money printing and lots of handouts. And this is good for one sector, and that is for gold, gold miners, and silver. And I believe every dip over the next few months, probably the next few years, I believe will be buying opportunities in these names. And silver so far has lagged, but I think at some point silver will come roaring back. But when it does, it is probably more at the end, the tail end of this, because silver goes parabolic when people are panic buying. So we have to keep an eye on it. The best risk reward, I believe, is in GDX, to buy dips in GDX, because if you take a look at a long-term chart in gold and compare it to a long-term chart in GDX, gold is a lot higher than it was, for example, in 2016, but gold miners are still below those levels. So there's a lot of catch-up that miners can put in. And once that index breaks above 32, I believe there's massive upside there. And a lot of people will be left behind, because once that happens, there will be a lot of chasing going on. And so I believe there we have an excellent risk reward here. And then there's the second trade, and that is simply based on the idea that the sentiment is so bearish that it's very difficult for the next few weeks to be disappointing. That news is worse than we already expect. That, in combination with the gamma positioning about to flip from short gamma to long gamma, I believe makes shorting volatility here an excellent risk reward. So what I will be doing going forward is I will be buying dips in GDX, and I will be selling rips in UVXY and TVIX. And if you want to learn more about it, how we address the market, you can find more information on quantiyeti.com. If you have any questions to me personally, hit me up on StockTwits. My handle is @OptionBob.